Alright, so hello everyone, I hope you guys are doing okay. Welcome to another lectures video for our tax class. So before we start with the chapters, I just want to make a few announcements. It's not exactly an announcement. I already sent an email last night, but I just want to mention it again here. So I have worked on the schedule a little bit, and so far my plan is to have exam number 2 on April the 2nd, on this date, right? And then exam number 3 is going to be on Thursday, April the 23rd, and then our final, the new final date is going to be May 12th, and it's going to be from 1 to 2:15, I believe. Let me recheck it again. Yes, from 1 to 2:50 p.m. on May 12th, on Tuesday. Right, so all of the exams is going to be available through Blackboard, and all the exams going to be timed. And in terms of the format of the exam, most likely, I haven't decided yet, but most likely it's going to be multiple choice format, similar to the first exam that we did. Okay. Yeah, so because it's online, so I'm not sure how I'm gonna talk to you guys, but I believe you are all adults, and I believe you're gonna be truthful and not gonna cheat on the exams, So that's just a few announcements that I wanted to make, and yeah, just hope you guys are doing fine. So let's get back to our chapters. So last time we stopped here, we already talked about AMT, right, alternative minimum tax, a little bit. So now let's talk about let's continue with our chapters. Right. So last time we stopped here. So in the next part of the chapter, I'm going to introduce you a few additional taxes that are available out there, that taxpayers may or may not have to pay. It's just some additional taxes, and it's depending on your filing status, your tax bracket, that you may have to pay some additional taxes. Right? So the first one is net investment income tax. So this tax is imposed on people with high income who have high investment incomes. So for people whose modified AGI is over $250,000 for married filing jointly, taxpayers, or whose have $125,000 of modified AGI for married filing separately, and the threshold is $200,000 for all others, taxpayers. So these are the threshold to kind of tell us who's going to be subjected to this tax. So for people whose modified AGI passes the threshold, then they may have to pay the additional net investment income taxes. So the net investment income tax is a flat rate. It's a flat tax at 3.8%. And the tax is imposed on whichever lessers of net investment income, or whatever the amount that go above the modified AGI. So the first case, the net investment income, is pretty much includes everything, every type of investment income that you may include in your gross income. So for example, interest income, dividend income, annuity, royalty, rent income, passive activity income, pretty much all sort of investment income that you include in your gross income. So the tax, the flat rate tax, that's 3.8% on whatever lesser amount of net investment income or the excess of the modified AGI, right? So if your modified AGI is above the threshold, then you have to pay this tax, and the tax is taxed at 3.8% of either one of these amounts right here, net investment income or the excess of modified AGI. Right? So all right. So I just want to give you an overview of this tax, just like an introduction of this concept. And the second type of additional, well, not additional, but everyone has to pay this tax, right? But and we kind of talked about this in previous chapters, so FICA taxes, right? So for FICA taxes, it includes two major components, right? So we have Social Security tax and Medicare tax. So for Social Security tax, for taxpayers, right, everyone has to pay a flat rate of 6.2%, and for Medicare tax, the tax rate is 1.45%. Right. For Social Security tax rate, there's a cap, there's a limit on the base of the income that can be used to calculate the tax rate. So basically, if you make more than $132,000, $132,900, right, you don't have to pay the additional tax that are on the part of the income that are higher than this limit rate. So basically, you only pay 6.2% of the $132,900. Right. For Medicare, there's no limit, so you have to pay Medicare. The base that you have to use to calculate Medicare is going to be whatever your taxable income is, right? But for Social Security, again, there's a limit on it, and it's $132,000 and $900, right? So keep that in mind, right? As we have discussed in previous chapters, so for FICA taxes, the employee, right? If you are employed by someone, so the employee taxpayers gonna pay 6.2% of Social Security plus 1.45% of Medicare tax, right? And then for the employer, they have to pay exactly the same. They have to match with whatever the employee paid, right? So employee, they pay 6.2% plus 1.45%. For employer, they also have to pay 6.2% plus 1.45% for each employee that they employed, right? And in terms of how the taxpayer pays, right? So probably we all know that FICA taxes are withheld by the employers, right? So every month you receive a check for your salary, right? And it's never going to be the exact amount that the employer promised you in the contract, right? Because they already withhold, the employers already withhold a portion of your income to pay for the federal income tax and for the FICA taxes, right? So the employers, they have the responsibility to withhold the money, the taxes, the FICA taxes for the employees. Right? So again, for FICA taxes, just remember that the employee and the employer each have to pay their share, which is exactly the same. And for Social Security tax, the tax rate is 6.2%, and for Medicare tax, the tax rate is 1.45%. And for Social Security, there's a limit. Right? There's a limit on the base income that is used to calculate the tax, and the base is $132,900. Right. And for Medicare tax, there's no limit, so you have to use the taxable income to calculate that amount, the amount for the tax. All right. So this is a case. It's a very basic case, right? And this is probably the most common case that we face in our daily life, right? Where the taxpayers is an employee of someone or some companies or some business, right? What if the taxpayers is a self-employed person? So taxpayers has his or her own business and doesn't work for anyone, right? So if that's the case, then we have to reconsider the scenarios a little bit, right? Right. Oh, I forgot to go over this example. So this example is pretty much kind of illustrate what we just talked about. Right? So let's see. So in this case, Alan received $50,000 in wages working part-time for an off-campus employer during the year, and it asked how much is her FICA taxes should Alan employer have withheld from her paychecks, right? So pretty much we know that she has to pay 6.2% of Social Security tax and 1.45% of Medicare tax, right? So and the base is $50,000, right? So first, for Social Security tax, since $50,000 is still lower than the limit rate, the $132,900, so we use the whole amount, $50,000, to calculate the tax liabilities for Social Security tax, right? So for Social Security tax, it's going to be $50,000 times 6.2%, which equals $930. And for Medicare tax, so it's going to be 1.45% times $50,000, which equals $218. So the total FICA taxes that the employer should have withheld from Ellen's paycheck is going to be the sum of that two rates. So this two rates. So it's going to be $1,148. Right. Pretty straightforward, pretty basic. And yeah. Right. So let's get back to our scenario here. Right? So what we're talking about here is the cases where the taxpayer is self-employed. Right? So when a taxpayer is self-employed, she or he is her or her, let's say she is her own employer, right? And she's also an employee as well in some cases, right? So for self-employed taxpayers, the taxpayers have to pay the share for both the employer share and the employee share, right? So because we know from here, right? We know the employee have to pay 6.2% plus 1.45%, right? And then the employer also have to pay the exact same share, right? So for self-employed taxpayers, they have to pay double the FICA taxes, right? Because they have to cover the portion of the employee and also have to cover the portion of the employer, right? So how do we deal with that, right? So Congress, they kind of give self-employed taxpayers a break, right? So what we do is we sorry, switch on a little bit. So what we do is we take out a portion of the employer from the tax base before we calculate anything, right? So that's why for self-employed taxpayers, the tax base, right, it's not going to be taxable income, right, to calculate the FICA tax. It's going to be the taxable income times 0.9235, and the reason why is this, it has to come by 0.9235 is because these taxpayers, for self-employed taxpayers, they are kind of implicitly they can implicitly deduct the portion of the FICA taxes for the employer part, right? So which is 6.5% plus 1.45, 6.2% plus 1.45%, which equal 7.65%, right? So that's why the Congress and the IRS say, okay, we allow you to take out that part from the base from the baseline, right? So they can implicitly just deduct that part, right? So that's why they took out that 7.65%, right, out of the net base. So that's why it left us with this 0.9235, right? So to calculate the base of the tax base for the FICA tax, we take the net earnings, right, of the self-employed taxpayers times 0.9235, right? And then after that, we can follow the same kind of step to calculate the FICA taxes for the person. But keep in mind that after they already got deducted, they already give the deduction of the employer portion, right? After the 0.9235 here, when they apply the tax, when they calculate the FICA tax with the new tax base, they still have to pay the employer portion then, right? So let's go through these steps to maybe I'll be able to explain it a little bit more clearer. Right, so this is the step I got this from the e-textbook, right? So here are the steps to calculate the FICA tax liabilities for a self-employed person. Right. So first, to calculate the amount. Step 1: calculate the amount of taxable net income from self-employment activities that's subject to self-employment taxes. Right? So basically, whatever the net income that this self-employed person made, right, during the fiscal year, right? So it's going to be the net income from the self-employment activities. Right. So step 2 is to multiply that amount, the net income from self-employed activities, by 92.35%. Right. That's what we just talked about. Right. So this is going to be the net earnings from self-employment. So this is going to be the base, the new base that we're going to use to calculate the FICA taxes, right, for this self-employed person, self-employed taxpayers. Right. So that's step 2. Step 3 is now we start to calculate the Social Security tax. Right. We apply the tax rate, and remember, as I mentioned, right. So after the taxpayer already deduct the 7.65% they already take out the 7.65% of the net income. Now with the new base, they still have to pay for the employee part and the employer part portions of the FICA taxes, right? So now to calculate the Social Security tax, we take this base, this net earnings from self-employment that we calculated from step 2, we times 12.4%, right? Because here the taxpayer still have to pay for the employee part and the employer part of the Social Security tax, right? So that's why 6.2 plus 6.2 that's why 12.4%, right? So step 3. Step 4, we calculate the Medicare tax, right? So for Medicare tax, again, the taxpayer have to pay the portion of the employer and the portion of the employee, right? So it's going to be 1.45 plus 1.45 equal 2.9%. So we take this base, this net earning from self-employment, we multiply it by 2.9%, and that's going to give us the Medicare tax for these taxpayers, right? And then in step 5, we calculate the additional Medicare tax rate. And I think I may have forgot to mention this part of it. So again, for taxpayers who make who earn very high income rate, who have AGI. Let me go back here. For taxpayers who have salary or wages that that are above $200,000 for all taxpayers, right? And the threshold is $125,000 for married filing separately taxpayers, and the threshold is $250,000 for married filing jointly couples, right? So if the salary in wages, right, if the compensation of the taxpayers go above this threshold, then they also have to pay an additional amount of Medicare tax, which is 0.9%, right? So this applies to for everybody, right? All right. Sorry, I forgot to mention that, right? So because that additional Medicare tax apply to all taxpayers, right? So in here, in the case of a self-employed taxpayers, he or she also needs to pay for that additional Medicare tax, right? If the earnings is above the threshold, right? So the threshold again is going to be $200,000 for all taxpayers, except married filing except for married filing jointly and married filing separately, right, whose threshold is $250,000, $250,000 and $125,000, respectively, right? All right. So if the self-employed taxpayers earnings is above that threshold rate, then we need to calculate the additional Medicare tax, the 0.9%, right? So how do we calculate that? We calculate that by taking the 0.9% multiplied by the net earnings, right? The net earnings that is above the threshold, right? That is. So let's say a person whose net earnings is $250,000, right? And a single taxpayer, self-employed, who make $250,000 from his business. So he's going to need to pay additional 0.9% on the $50,000 in excess of the $200,000 threshold right here, right? So pretty straightforward, right? So again, for self-employed taxpayers, the steps that we need to take to calculate the FICA tax is a little bit more complicated, but still it's not that difficult, right? So let's go through the example together, and then maybe we can have a better idea, right? So in this case, says Courtney's only income for the year is her $80,000 in net self-employment income from her weekend consulting business. So she made $80,000 a year, and that is her only income, right? So the question asks, what amount of self-employment taxes and additional Medicare tax would Courtney be required to pay on this income? All right. So first, right, so we just need to follow these 5 steps, right? So first, we need to, step 1 is to figure out the income coming from the self-employed activities, right, which is $18,000. They already told us, right? And then step 2 is to take that amount in step 1 times 0.9235, right, or 92.35%, right? So that will give us the net earnings from self-employment, or the base that we're going to use to calculate the FICA taxes for this lady, right? So we have $18,000 times 0.9235, and that gives us $16,000, $60,623, right? So now we have the base to calculate our FICA taxes, right? So then step 3, now we calculate the Social Security tax. We take the $16,623 times 12.4%, right? And again, the reason why 12.4% is because the self-employed person, the self-employed taxpayers have to pay the FICA portion, the Social Security portion of both the employee and the employer, right? Because she's employed herself in in a self-employed person, in a self-employed business, right? So that's why. Right, so we take $16,623 times 12.4%, which gives us $2,061. Right, so this is going to be her Social Security tax. So that's step 3. Then we move to step 4. In step 4, again, we take the amount, right? We take the tax base rate, which is $16,623 times 2.9%. Right, again, and this is 2.9% because she had to pay for the portion of the employee and the portion of the employer, right? So that's why 2.9%. If it is just for the employee part, it's going to be 1.45%. Remember, right? So that gives us $482. Right. So this is going to be her Medicare tax from her self-employment, right? And then since she only make $18,000, right? So her income is too low, right? Remember, the threshold is $200,000, right? For pretty much all taxpayers except for married filing jointly and married filing separately. Right? So her income here is $80,000. It's way below $200,000, right? So that's why she doesn't have to pay any additional Medicare tax. Right? So in the end, we just need to add all the amount up, right? So we know she had to pay $2061 for Social Security tax and $482 for Medicare tax. So the sum of that is going to be $2543. Right. So again, it's not that hard. It's really straightforward. We just need to be careful when we calculate the base rate, the tax base rate. But remember, we have to take out the 7.65% from the taxable income first, right? By taking the taxable income times 0.9235, right? And then when we calculate the Social Security tax and the Medicare taxes, we have to remember to times 12.4% and 2.9%, right? Because this taxpayer is paying for both the employee portion and the employer portion of the FICA taxes, right? Alright, so this is the case where the taxpayer is self-employed, right? But as we know in real life, there's a lot of taxpayers who have a normal job, who is employed by some companies, and also on the side they have some private business of their own, right? Some side jobs, right? So if that is the case, then how do we calculate the FICA taxes, right? Because it's kind of a little bit more complicated, right? Because now this person had to pay FICA taxes on her jobs as an employee, and the person also have to pay the FICA taxes on the job where she is the owners of the business, right? So this part can get a little bit more tricky, right? So for these cases, we have to we have to follow a process, right? So first we have to calculate the FICA taxes for the taxpayers, for the employee first. So let me say again. So first we have to calculate the FICA taxes on the employee compensation of these taxpayers first, right? By ignoring the compensation from her self-employed, from her private side business, right? So first calculate the FICA taxes that she had to pay on her employee compensation, which basically is a 6.2% times plus the 1.45%, 6.2% of Social Security and 1.45% of Medicare taxes, right? Right. So And then after that, we proceed to calculate her tax, her FICA taxes on her self-employed business rate. So yeah, but remember that there's, for Social Security tax, there's a tax base limit. Remember, there's a tax base limit of 132,900 dollars, right? So what happened when the taxpayers have two jobs, right? So what we do is after we calculate the FICA tax portion of the person of the employee on the employee compensation of these taxpayers, right? We have to remove that. We can take out the compensation from this limit rate. So pretty much for the self-employed business of the taxpayers, she only had to pay Social Security taxes on whatever left over after we already take out the compensation base from the limitation, from the tax basis limitations, right? So let's go through this step again, right? Maybe I'll be able to explain it a little bit more clearer, right? So okay, so let's see. So for Social Security tax, right? And this is a step we need to follow to calculate the self-employed portion of the FICA tax of the person. And this person has two jobs, right? She worked for some employer, and she also have a side job where she's a self-employed person, right? So for Social Security tax, first we determine the limit of the Social Security portion of the self-employment tax base, right, by subtracting the employee compensation from the Social Security wage base, right? So that's what I just mentioned, right? Because we already calculate the compensation, the FICA taxes on the employee compensation, right? We have to take that employee compensation out of this base limit, right? And then for the self-employed components, we only pay taxes on whatever the difference between the base limit and the employee compensation, right? So again, this kind of give the taxpayers a little bit of the benefit right here, right? Because now the tax base is going to become very small, right? So let's say the employee, this person, the taxpayers, she has a job, work for some company, and that company pay her, let's say, $100,000, right? So whatever leftover that she have to pay for her self-employed business, it's just going to be $152,900 subtract $100,000, which is $32,900, right? So that's going to be the base to calculate her Social Security tax for the self-employed business, right? All right. So that's step one. Step two, again, we have to determine the net earnings from self-employment, right? Because it's a self-employed, so we still have to take out the 7.65%, right? So that's why we still times this net base with 92.35%. Right. So that's step two. In step three, we multiply whatever the lesser of step one or step two by 12.4%. Right, right, and this is going to be the Social Security tax for the self-employment component of these taxpayers, right? And the reason why we multiply the lesser of step one and step two, right? So remember, step one now is going to be the new base limit, basically, right? Right, that the base limit for the new base limit for the self-employment component, right? And then step two is to calculate the real net earnings from the self-employment activities, right? So if if the earnings from the self-employment activity does not exceed the base, which we calculate in step 1, right, then we can use that amount. Right? But otherwise, if the earnings from the self-employment activities is greater than the base from step 1, then we have to use the step 1. Right? That's the reason why we have to multiply the lesser of step 1 and step 2. Right? So yeah, so I hope that is clear enough. Right, so that's Social Security tax. What about Medicare tax? Right. So again, for Medicare tax, and remember, for Medicare tax, there's no base limit, right? So that's why we just go straight up, taking the step 2 amount, excuse me, step 2 amount, right, which is the earnings, the net earnings of from the self-employed activities. Take that multiplied by 2.9%, and that's we're gonna have the Medicare tax for the self-employed activities of these taxpayers, right? All right. What about for additional Medicare taxes? So remember, when the taxpayer's earnings is above the threshold rate, then he or she need to pay 0.9% of additional Medicare tax rate. So again, we follow the procedures. Right? So in step 5, we add the amount from step 2 and the taxpayer compensation. Right. So step 2 is the net earning from self-employment, and the taxpayer compensation from this is the employee compensation. Right? So if the married filing jointly, if the taxpayer is married filing jointly, right, we also have to add back the compensation of the spouse, right, because they're filing together, right? So the reason behind this step is, well, here we just try to calculate the total compensation, the total income of these taxpayers, right? So we take that by adding the compensation, the employee compensation of these taxpayers. We add it with the earning from the net earning from the self-employment activities, right? So now we have the total earnings, the total income of this person, right? So now we use that total amount to judge whether or not this person earn above or below the threshold rate. So if these taxpayers earn above the threshold, then we have to take 0.9% times the excessive amount that is above the threshold, right? So which is pretty much similar to the other 2 cases that we talked about earlier, right? All right, so that's that. So let's whatever we should talk about is kind of hard to imagine, right? So let's go through an example together. Hopefully it's going to be clear a little bit, right? So look at this case. So it's a Courtney received $100,000 of taxable compensation from this company in 2019. And she received $180,000 in self-employment income. Wow, that's a lot. Right. So, from her consulting activities. So it asks, what amount of self-employment taxes and additional Medicare tax is Courtney required to pay on her $180,000 of business income? Right. So, and it's assumed that employer correctly withheld $62,000 from the Social Security tax, and for the $1,450 of Medicare tax and 0 additional Medicare tax. Right. So we just need to apply this procedure, right? These 7 steps. Right. So first, we have to determine the new basis, right? The new tax base for the Social Security tax. Right. So we have to take out the employee compensation from the base limit, from the $132,900 base limit. Right. So first we take out that compensation from the base limit. So we take 132,900 subtract $100,000, and that gives us 32,900. Right? So this is going to be the new base, the new tax base for the Social Security portion, Social Security tax for the self-employed activities. Right? And 2, we calculate the net earning from the self-employment. Right? So her Courtney's net earnings from Courtney total earning from self-employment is $180,000, right? So we take that times 92.35%, and that gives us $166,230. Right? Remember this step: determine net earning from self-employment. Right? We times it with 92.35%. All right. So that's step 2. Step 3. We calculate. Right? We use the tax base to calculate the tax liability. Right? So we take the lesser of step 1 and step 2. Right. So step 1 it gives us the limit. Right. Step 2 gives us the net earnings from the self-employment. So the limit is only 32,900. Right. So we take that. So Courtney only need to pay. Only need to use this amount to calculate her tax liability for Social Security tax rate, even though her net earning from self-employment is $166,230. So this is why I say the way to calculate this FACA tax kind of give the self-employed person, the self-employed taxpayers, a little bit of benefits. So we take in this case we take $32,900 times 12.4%, and that will give us $4,180. Right. All right. So that's the Social Security portion of the self-employed tax. And then Medicare tax. Remember, Medicare tax has no tax limit, right? So we just take straight up the net earning from self-employment, right? The $166,230 times 2.9%. So that gives us 4821. Right. So now we have the Social Security tax and the Medicare tax for the self-employed activities of these taxpayers. Right. All right. So and then now we have to figure out whether or not Courtney have to pay the additional Medicare tax for her self-employed activities, right? For her self-employed jobs. So we do that by adding her employee compensation. We add that with the net earning from self-employment rate. We are following step 5 here, I believe. Yeah, we're following step 5 here. Right. So we take $100,000 at. We would plus $160,000, $160,230. So that gives us $266,230. Right. So now Courtney is the head of household, I believe, and so that means her threshold is going to be $200,000. Right. So that's why she have to pay additional tax on the $66,000 that is higher. That is above the threshold of $200,000. Right. So we take 66,230 times 0.9% of the additional Medicare tax rate, right? And that gives us $596. Right. So, and then in step 7, we have to subtract any additional Medicare tax that is withheld from the employer, right? So because the employer also have to, when they withheld the FACA taxes, right, they also have to withhold additional Medicare taxes as well if the compensation is go above the threshold rate. But in this case, as we know, there's 0 additional Medicare taxes that is withheld from her paycheck, right? From her paycheck by her employer, right? So in this case, that's 0, right? And the reason why we take it out, we take out the additional Medicare tax with our employers, because we don't want to ask taxpayers to pay for that again, right? Because she already paid, if her employer already withheld the additional Medicare tax on the compensation rate. We don't want her to pay that again on the again rate, because here the 596 here is the additional amount for additional Medicare tax for both self-employed activities and the employed activities, right? So that's why we want to take the additional Medicare tax from that has been withheld by the employer out of this amount, right? So after that, the total FICA taxes for the self-employment activities is going to be the sum of steps 3, 4, and 7, right? So steps 3 and 4, we know we have we already calculated the Social Security tax and in step 4 we calculate the Medicare tax rate. So step 3 and step 4 give us the Social Security tax and the Medicare tax portion of from the self-employed activities, right? And then in step 7 we have the additional Medicare tax the additional Medicare tax that the taxpayers have to pay on the self-employed activities, right? So we add steps 3, 4, and 7 together, and we have 94 and 97. All right. So I hope that is clear enough. And I understand this is a little bit more complicated, so on the exam, I think I may not ask you about this scenario here, where the taxpayer is paying, the taxpayer is working for pretty much he or she work 2 jobs, right? For working for some company, and then also a self-employed person also own a business, right? So I may not ask you this scenario in the test, because it's quite complex, and it may need significant amount of time to solve my problem like this. So I may not ask you this scenario in the test, but I may ask you the scenario where the taxpayers is employed by someone, so probably only have one job, work for someone, right? Or the taxpayers is self-employed and doesn't work for anyone, right? So those 2 scenarios are a little bit more easier, a little bit less complex, and it takes less time to solve. All right. So, but still, you may need to know how to solve this, how to work this, to be able to do your homework, So, all right. So let's move on. So, so what happened when an employee is a contractor of the firm? So sometimes it's kind of fuzzy to determine whether or not the taxpayer is an employee of a company or is an independent contractor of that company, because the reason why we have to differentiate between these 2 status of the taxpayers is because as we know, we already talked about the FICA taxes, how to calculate FICA taxes for a person who is employed by someone who have a job with some company, right? And a taxpayer who self-employed, right? So a self-employed person can, and a contractor pretty much can, an independent contractor pretty much can classify him or herself as a self-employed person, right? So we know that the FICA tax calculation is relatively different between the person who works for some company and for an employee and the self-employed taxpayers, right? So that's why we need to differentiate between these two status, right? Right. So how do we differentiate between these two now? So again, this a lot of times it can be fuzzy to differentiate between an employee and an independent contractors, So that's why the IRS, I think they publish a list of factors that can pretty much can use to be that taxpayer can use to kind of classify themselves as whether or not they are an employee or whether or not they are an independent contractor, So some of the question can be here. I just want to show you some of the question, So and this question are on page 21 in the book, So so whether or not the taxpayer set her own working hours, whether or not the person work part-time, whether or not the person works for more than one firm, whether or not the person realizes either a profit or a loss from the activities, whether the person taxpayers performs work from somewhere other than an employer's premises, whether the taxpayers work without frequent oversight. Right, so here are some of the example of the question of the factors that the IRS want you to use to classify yourself, whether or not you are an employee or whether or not you are an independent contractor. Right? So if the answer to these questions are yes, right, then it's most likely the person can be considered as an independent contractors, right? So yeah. So and then another reason why it is important to be able to differentiate between the status, right, between employee and independent contractor is the tax treatment, the calculations of the deductibility of the expenses, right? So if you are an employee, right, right. So for example, if say for example, if the type of employee, if we know like some of the employee expenses, right, that are not reimbursed by the employers, the taxpayers cannot, the employee cannot deduct anything out of that rate. As we kind of discussed about this a little bit in earlier chapters, right? However, for self-employed taxpayers, right, they can pretty much deduct a lot of their expenses and right, a lot of their business expenses under 4HI deduction. Right? So that alone is kind of giving an idea of how deductibility can be very different between these two status, right? Between employee and independent contractors, right? So that's why it is, again, it's important to differentiate between these two status, right? All right, so that that concludes the portion of the chapter where I want to introduce to you the different kind of taxes that the taxpayers have to fulfill, to pay. So in this part of the chapters, I want to talk about tax credits a little bit, because as you know, the computation of taxes, right? In the end, after you already calculated your tax liabilities using the whatever tax rate that you use, and to calculate rate. So after that, you're gonna be able to get to the tax liabilities numbers, right? But then after tax liabilities numbers, there you have to consider whether or not the taxpayers have some tax credits, right? And if the taxpayer have tax credits, then the final tax due is going to be lower than the tax liabilities numbers, right? So Right, so let's talk about tax credits. So for tax credits, usually we can classify tax credits into three major types, three major categories. Right, so non-refundable personal, refundable personal, and business. So as the name suggests, right, for non-refundable personal credits, basically if you have the credit, if the taxpayers have the credit and they use it to bring down their tax due or tax liabilities, right? If let's say if the taxpayer tax liabilities is $1,000 and the tax credit is $2,000, then the tax credit is gonna bring the tax due to zero, right? Because the liabilities is only $1,000 and then the tax credit is $2,000, right? So it's gonna bring down the tax liabilities, the tax due to $0. Right? So basically, the taxpayer don't have to pay any tax at all. However, there's the additional $1,000 that are unused, right? So for non-refundable personal tax credit, as the name suggests, the unused credit cannot be refunded to the taxpayers, right? And then for refundable personal tax credit, on the other hand, the leftover, the unused credits can be refunded to the taxpayers, right? All right, so let's talk about each of these types first, right? So for non-refundable personal, there's several types of tax credits programs, So the first one is child tax credit, in which we're pretty much very familiar with, right? We kind of talked about this in the chapters, and we actually use that in our problems before, right? So for child tax credits, as we know, taxpayer can claim $2,000 of credits, of child tax credits for each qualifying child who is under the age of 17, right? And then the child has to be qualifying child and has to be under the age of 17, right? And then after that, for each after already consider the child, the qualifying child, if the taxpayer still have some dependents, some other type of dependents, maybe qualifying relative, maybe parents. Excuse me, I think there's something going on outside. I have to check a little bit. Let me pause here. All right. Sorry about that. I think my neighbor has some medical issue. I hope they're okay. All right. So let's get back to our chapters. So the child tax credits. So for each qualifying child under the age of 17 at the end of the year, they can receive $2,000. They can claim, the taxpayers can claim $2,000, right? And then if the taxpayer has additional qualified dependents, maybe some qualifying relatives, they can claim $500 for each qualifying dependent, and then the child tax credits can be phased out, depending on the tax bracket, the income level of the taxpayers, I don't think I have the phase out level here, but let me go to the textbook real quick so I can show you the phase out. Right, so pretty much the phase out is going to be, I think, how much percent? It's going to be $50 for every $1,000 that are above the threshold. Right, so let's see. Right, so here's the phase out threshold, right? So if the income the AGI of the taxpayers is higher than this threshold, then the phase out start to kick in, and the rate of phase out is going to be $50 for every $1,000 of income of AGI that is above the threshold. So let's say if a maritally jointly couples whose AGI is, let's say, $410,000, right? So they have a $10,000. So $10,000 is going to be the amount that they go above the phase out threshold. So the threshold is going to be 50. The threshold, the phase out amount is going to be $50 times 10, because it's going to be 50 for each $1,000. So 50 times 10 is going to be $500. So that means the tax credit, the child tax credit, is going to be reduced by $500. Right. So that's just an example. Right. Let's get back to our slides. So what we talk about, just talk about child tax credits, right? And we are pretty familiar with this because we already kind of know about this in earlier chapters, right? And then there's another type of tax credit program that is designed to kind of help our families who have to support multiple kids, who have to support, who have a lot of dependents, who have dependents and who have a child, So this is just another tax credit program, For this tax credit program, taxpayers have to have a dependent, right? Like the name suggests us. So the dependent need to be under the age of 13, or the dependent had to be a disabled dependent. It can be a spouse or parents, but the dependent had to be disabled, right, to be able for the taxpayers to claim this tax credit program, So for this program, the way we can calculate this program is to use a predetermined percentage to calculate, and then apply times that to some amount to calculate the expenditures, to calculate the tax credits, So the expenditures that we can use to calculate the credit is going to be the least of these three categories. First, the least of the following: $3,000 for one qualifying person, and $6,000 for two or more qualifying persons. Right. So if the taxpayers have one underage, depending on underage kid, he or she can claim up to can use $3,000 or as an expenditure, or if the taxpayers have more than one, maybe two or three, then they can use $6,000 as the amount of expenditures to calculate the tax credit. Alright, so that's the first category. The second category is going to be the total amount of the dependent care expenditures for the year. Right. And number three, the third category is going to be the taxpayers' earned income, including wage, salary, and other taxable compensation. So it's going to be the earned income, whatever amount that they earned. So the expenditure is going to be the least amount of these three. Right, and then we use that expenditures, applying times some predetermined percentage to calculate the tax credit amount that we can use for the taxpayers. Right. So for the percentage, for the predetermined percentage, there's a schedule. Right. So let's see. So depending on the AGI of the taxpayers, we have different percentage that we can use to calculate the tax credits, right? So, for example, if for the first case, if the AGI is anywhere between $0 to $50,000, then the percentage is going to be 35%, right? So, let's say if the person used the $3,000 of expenditure here, then it's going to be 35% times $3,000, right? And whatever the amount, whatever the result is going to be the amount, the tax credit that the person can use, right? And so it depending on the level of AGI of the taxpayers, right? That we have different percentage amount that we can use, right? And as you can see, the higher the AGI, the higher the income of the taxpayers, the lower the percentage rate. So that makes sense, right? Because if your income is high, then maybe you don't need that much support anyway, right? So all right, so that is the child independent care tax credit, right? So the next types of tax credits I want to introduce to you is the American Opportunity Credit, and this program may be relevant to a lot of you, right? Who are going to college and have to support yourself, right? So for this program, it's primarily designed to motivate students to study, to get a higher education degree, right? So basically, this tax credit program is applied to taxpayers themselves who the taxpayer can claim it for themselves. If they go to school and they have to support themselves to school, they can claim it for themselves. And if they're supporting some dependents who go to school, let's say the taxpayers who are parents have kids going to college, then they can also can also claim this credit program. Or even if the taxpayers is paying for someone else's kids, right? So my sister have a kid and I pay for her kid to go to college, then I can also claim this tax credit, right? Because I'm supporting someone else on behalf of their parents to go to college, right? So this tax credit apply to people to taxpayers who need to cover the cost of education for the first 4 years of post-secondary education. So pretty much, if you go to college, the first 4 years of college, the expenses that you pay for the first 4 years of college, you can if you're paying such expenses, you can claim this program. You can claim the credit from this program, and the eligible expenses it has to cover the education. It has to cover tuition, it has to cover fee, it has to cover the materials of the education. So if you are paying such expenses, such cost expenses for yourself to go to school, or for your dependent to go to school, or for someone else to go to school, you can claim this tax credit program, right? All right. So the way this tax program works is it's going to be 100% of the first $2,000 of eligible expenses and 25% of the next $2,000 of eligible expenses, right? So let's say you are going to UTSA and maybe you have some scholarship and you only pay maybe $3,000 for everything, like for your tuition, for your books, for your living expenses, only $3,000 to go to school, right? So if that's the case, if you pay $3,000, you can apply 100% of the first $2,000, right? So that means you can claim $2,000 of credit for the first $2,000 expenses, and then 25% of the next $2,000. So 25% of the next $2,000, right? So in this case, since you pay $3,000, right, and you only claim the first $2,000, so that means you have $1,000 left, and then since the maximum credit is $2,500, you can claim the other $500, right? So pretty much you can claim in total. You can claim $2,500 of tax credits, right? Pretty much. Right? So again, like other tax credit program, there's some phase out structures, that apply to this credit, and it's all again, it's depending on the income level of the taxpayers, right? So it is a pro rata phase out kind of structures, and the phase out range is going to be coming from $160,000 to $180,000 for American filing jointly taxpayers, and $80,000 to $90,000 for all other kind of taxpayers, right? So, but again, this phase out, I don't think is applied to majority of students out there, right? Because probably I would think students make that much of AGI for during their education, right? Unless they are working personnel and then they go back to school, right? Right. So let's see. Let's and remember, this is a pro rata phase out structures, right? So it's going to be a little bit different from other kind of structures, right? So let's go through this example to see how the pro rata phase out structures works, right? So so Courtney paid $200 tuition and $300 for books for her kid Alan to attend University of Missouri, Kansas City during the summer. So what is the maximum American opportunity credit before phase out Courtney may claim for these expenses? Right. So let's see. So before any phase out, right, we have we know the student can claim the first $2,000 and then 25% of the next $2,000, right? So since Courtney is paying $2,000, pretty much $2,300 for her daughter to go to school, so for the first $2,000 she can claim the whole amount, right? But for the $300 she can only claim 25% of that $300, right? So in total, before considering any phase out structures, Courtney can claim $2,075 of tax credit for the American Opportunity Credit Program. Right. All right. So, and then let's assume that her AGI is $162,000. So now what, right? So now the phase out program gonna start to kick in, right? Because now her AGI is way above the threshold rate. So let's look at the threshold again. So the threshold for the phase out threshold for taxpayers is ranging from $80,000 to $90,000, right, for all other taxpayers except for American filing jointly, right? So what is the tax filing status of Courtney? They don't mention here, but let's see how they do it. So let's see. So here they assume Courtney is married, right? So Courtney is married filing jointly with someone. That's why they use the range of $160,000 to $180,000, right? So first we know that the before phase out credits is $2,075, right? And her AGI is $162,000, and the phase out threshold is $160,000, right? So the amount that is above the threshold is going to be $2,000, right? 162 subtract 160, $2,000. And then we know that the range of the phase out is going to be $20,000, right? So because it is the range is from 160,000 to 180,000, right? So the range is 20,000, right? So the phase out percentage, that's why it's called pro rata, right? So we're gonna take the $2,000 of excess AGI, right? The amount that is above the threshold, divided by the range, divided by $20,000. So that gives us 10%. Right? So the phase out amount is going to be 10% times 2075 here, right? So the phase out amount is going to be $208, right? So the credit after phase out is going to be 2075 subtract 208, and that gives us 1867. Right. All right. So that's the American Opportunity Credit Tax Credit Program. There's also other programs that kind of help taxpayers to go to school, to pay for their education. So the other program is called Lifetime Learning Credit. Right. So this program, the application of this program, the requirement for this program is a little bit looser, less restricted than the other one, the American Opportunity Program. So for this one, all the expenses that you pay for your grad school, for your professional school, you can also include that, right? Compared to the other program, it's only allowed you to deduct, not deduct, but to only qualify if you pay for the expenses of the first 4 years of post-secondary education, right? But for this program, it doesn't restrict at the 4 years, right? You can, if you're paying for your graduate school, you're going to for a master program or you're going to for a professional training program, you can be eligible for this credit rate. So for this credit is the percentage-based credit program, right? So the way we calculate the amount of credit that the taxpayer can use, you take 20%, and then we time with the expenses, right? So and then the limit of this is going to be $10,000. So the maximum amount of tax credit that a taxpayer can claim is going to be $2,000, right? 20% of $10,000, right? And then there's also a phase-out structures applied to this credit as well, but let's not discuss deeply into that. I just want to introduce you to this program. All right. So, and one more thing I want to point out is that taxpayer can only choose either of the program, either the American Opportunities Tax Credit Program or the Lifetime Learning Credits Program. Right? They cannot choose both. For other programs, they can pretty much choose everything. If they're eligible, they can choose multiple tax credit program. They can claim multiple tax credit program. But for the program that support education, they can only choose either one, right? Either the American Opportunity Program or the Lifetime Learning Program. Just want to point that out. All right. So all of the 4 types of tax credit program that we just mentioned, that we just discussed, are non-refundable personal tax credits, right? So let's talk about some of the refundable personal tax credit program that are available out there. So the first one is called Earned Income Credit. Right. So for this program, it is designed to help taxpayers who have low income, and it kind of encourage people who have low income or doesn't have a job, kind of motivate them to go find a job, find employment, So, and because this is the refundable program, so that's why sometimes people can call it and refer to it as a negative income tax, right? Because if this applying by claiming this program, you already bring down your tax liability to $0, right? And if there's any leftover, if there's any unused credit, the government gonna refund it to you, right? So that's basically a negative income tax, right? Because you are receiving some money from the government without have to pay any taxes, right? So that's why some people refer this as a negative income tax, right? So the condition for a taxpayer to be eligible for this tax program is that the person have to earn some sort of income, have to have some earned income, meaning they have to work some way, right? And they have to be at least 25 years old and have to be in the range of 25 years old and 65 years old, or they have to have at least one qualifying child, right? So so because this program is kind of designed to support low income people, low income taxpayers, it's only the eligibility of this program usually only limit to people who have low income, So for people who have medium income to high income, they're going to be not eligible for this program. So let's look at this exhibit these tables to see how this program works, right? So depending on the number of qualifying children that you have, and depending on the level of earned income that you have, then we can figure out the credit, the tax credit amount, right? So for example, let's say in this case, you have 0 qualifying children, and then you make 69.20. So the credit percentage you have is going to be 7.65%. And as you can see, the more number of kids that the taxpayer has, the higher the tax credit percentage. Right? So let's see. So so after we figure out the tax credit percentage, we can take that times the earned income rate, and then that's going to give us the amount of tax credit that the taxpayer can claim, right? And then we also have a phase out structures here, So let's say, and then through this table you see if a person, like when a person can claim this tax credit, So let's say if first of all, if you have 0 children and you make somewhere, let's say $15,000, then maybe you can still claim some of the credit, right? But after 21, after your income rise above 21,370, then you cannot claim this credit anymore, right? So as you can see, based on the numbers of credit based on the number of qualifying child that the taxpayer have, and also based on the level of income that the taxpayer have, the phase out threshold can be increased, right? So again, it's kind of designed to help the taxpayers out to support their life and their dependents' life, right? So I just want to introduce you to this tax credit program. I'm not going to go any deeper. Just want to give you a brief introduction about this program. All right. So that is a refundable personal tax credit rate. So the third category of tax credit program is business credit, right? So for business credits, usually these kind of programs, they are designed to either promote people to engage in business activities, or to help to kind of subsidize the taxpayers if they are in some certain scenario that they have to face a double taxation or something like that, So and then for business credits, the good thing about business credit is that it can carry back for 1 year and then carry forward for 20 years, right? So let's say if you're eligible for the tax credit for this year, and then you don't use it, or you don't use all of it, then you can still use the unused tax credit for later the years, right? Or you can carry back 1 year, right? So it's not refundable, but you can use that. You can still save it for later use, or you can still use it for previous year, right? For the last year, right? But you can carry back 1 year. All right, so so I'm not going to talk a lot about this tax credit. I just want to introduce you the concept of tax credit, of business tax credit. And one example of business tax credit program that I kind of want to mention is the foreign tax credit. So for foreign tax credit, the taxpayers who earn some sort of income outside of the United States, who have some overseas income, then the taxpayer can choose to claim the foreign tax credits, But remember that before, in some previous chapters, we kind of talk about how taxpayers who have income overseas, right, how they treat it. So EU members, taxpayers who have incomes in foreign countries can choose to exclude up to a certain amount, right, of the income of foreign countries, right, or they can deduct a certain portion of that income they earn overseas, right. And then here I want to introduce you the third option that those people who have income overseas can choose, right. They can claim the foreign tax credits. But so basically, people who have income overseas can have three choices, right. But again, they cannot choose to do all the three options at the same time, right? They can pick only one option, right? So they can either exclude the foreign income from their taxable income, or they can deduct a portion of that foreign income, right, under I don't quite remember exactly, right? But anyway, or they can claim some foreign tax credit, right? So anyway, I just want to introduce you to this concept. I don't intend to go any deeper. It's just a concept that I want to introduce you to you. All right. So how do we apply all this tax credit? What is the order that we can apply it? So here it's going to present to us the orders how we can apply all this tax credit program. So if the taxpayer have multiple tax credit program, let's say they have all the three tax credit program eligible for all the three types of tax credit program, then the taxpayer have to apply non-refundable personal tax credit first, right? And then if they still have some tax due, after applying the non-refundable personal tax credit, then they can use the business tax credit, right? And then after that, if they still have some tax due, they can use some refundable personal tax credit to offset the tax due, right? So that's the order, right? So first, use the non-refundable personal credit. Second, use the business credit, and third, use the refundable personal credit. Right. And then here is also shows some of the characteristics of the different type of credits. Right? So for the first one, for the non-refundable personal credit, if we don't use all of the credit, then we're gonna lose it. There's no refundable. There's no carryover, carry forward. Right? For business credit, if we don't use all of the credits that we are eligible to, we can either carry back 1 year or carry over for 20 years, right? And then for the refundable personal credit, if we don't use all of them, then we can get refunded from the government. So again, I don't intend to go deeper into the tax credits, because there are multiple tax credit program out there, But and then I don't think we have enough time to go deeper into the tax credit programs. So yeah, I just want to introduce you some example of tax credits, But yeah, so let's move on because we don't have much time anymore. So so the last part of the chapter is we're going to talk about how taxpayer can pay for tax to the government, to the IRS, and how they can, what are the requirement for payment, what are the requirement for filing, So as you know, taxes we have to pay as we go, right? So basically, you can owe government any taxes. We have to pay as the tax expense incurred to us, right? So that's why every month when you receive a paycheck, the employer already withheld some of the income from the paycheck, right? Because you have to pay as you earn income, you have to pay tax to the government on the fly, right? You cannot own, you're gonna wait later or anything. So yeah, so you have to pay as you go, right? For in cases where the taxpayer work for some employer and then the employer withhold the taxes from the taxpayer paycheck, right? But for self-employed taxpayers and for corporation, there's no one withhold their money, right? The taxes, right? So in those cases, the taxpayers have to estimate the tax payments on a quarterly basis, and they have to pay tax on an estimate of the tax payments. Right? So, but still, again, right? The IRS, the government don't want taxpayers to underpay them, right? or have late payment. Right? So let's say even taxpayers estimate the amount of tax that they have to pay, but somehow the estimates come short, right? And it doesn't pay for all the tax due that they supposed to pay, that the taxpayer is supposed to pay. So then the taxpayer may receive some underpayment penalties from the IRS, right? So there are two options that taxpayers in those cases can follow to estimate their tax payment rate. So those programs is called safe harbor provisions, right? Excuse me. So the first option that the taxpayer can choose is to make sure that they pay 90% of the current tax liabilities, right? So that's the first option. The second option is to make sure that they pay 100% of the previous year tax liabilities, right? Or 110% of last year's tax liabilities if the AGI, if the taxpayer AGI is greater than $150,000, right? And they have to pay, yeah. So that's two-way rate. So first way, make sure that you pay 90% of the current tax liabilities. Right? Second way, make sure that you pay 100% of the previous year tax liabilities, right? And then you have to pay in a quarterly basis, right? So for the first case, every quarter you have to make sure that you pay 22.5% of the current year liabilities. Okay? And for the second case, you have to make sure that every quarter you pay 25% of the previous year liabilities, right? So to me, the second option can be safer, right? Because you know for sure what your previous year liability was, right? It's kind of harder to kind of estimate the current year liabilities because you don't really know, right? All right, so if the taxpayer follow these two options, then they may be able to avoid the underpayment penalties, right? But if for some reason they still receive the underpayment penalties because they don't follow these two programs, then the penalties gonna kick in, right? And the way to calculate the penalties is we use the underpayment amount, right? For each quarter time, the short-term rate, the federal short-term rate, plus 3%, right? So these are the penalties that the taxpayer who underpaid the IRS they have to receive. They have to fulfill these penalties. Okay. All right. So that is the underpayment penalties. That's the prepayment requirement rate. What about filing requirements? So we kind of talked about this a little bit in I think in chapter 1, right? Really far back. But for taxpayers who so not all taxpayers have to file for tax return, right? But the current requirement basically if your standard deduction is if your earnings, if your income is higher than your standard deduction, you know, depending on the tax filing status that you are qualified, then you have to, if the gross income is higher than the standard deduction, then you have to file a tax return. You know. Yeah, so but still, right, it doesn't mean that the taxpayers who don't have to file tax return, they cannot file tax return. They can, right? And in fact, the IRS, the government, encourage everyone to file tax return, right? Because you may be eligible for some return from the government, right? So why not, right? All right. So in terms of due dates for tax filing for individual taxpayers, the deadline is April 15th, and if the taxpayers decide to choose to have an extension, then they can choose to extend the tax filing the tax filing to 6 months, right? And for this year, right, in the U.S., because of the coronavirus pandemic that is happening right now, the government has extended the due date for tax filing to April to July 15th, right? So it's not April 15th for this year; it's already extended to July 15th, right? So, all right. So, what is the penalty for late filing, right? And then late payment as well, right? So for late filing penalties, it's going to be 5% of the tax that the taxpayer owns per month, and then the maximum amount, the maximum penalty is going to be 25%, right? Up to 25% of the owned amount, right? If the taxpayer is only simply filed late and not subject to any fraudulent kind of activities, but if the taxpayer is subject to some fraudulent activities that the IRS filed out, then they may ask the taxpayer to pay 15% of the tax owed per month, up to the maximum amount of 75% of the amount owed, right? So that's the late filing penalties. For the late payment penalties, so if this, as the name suggests, right? So if the taxpayers fail to pay the tax by the due date, right, of the return, then again the penalty is going to be 5% on the amount per month, right? On the amount that they fail to pay per month, and up to 25% of the owned amount if the taxpayer is not subjected to any fraudulent activities, right? And then similarly, if they're subjected to some fraudulent activities that the IRS somehow they figure out, then the penalty is going to increase it to 15% a month, right? 15% of the amount per month, and up to 75%. So, what if taxpayers have both late filing penalty and late payment penalties? What's going to happen then, right? Are they going to pay penalty for both, or what, right? So, under the current law, the maximum, if the taxpayers is subject to penalty payment of both late filing and late payment, then they only need to pay up to 5% per month, or up to 25% if the cases are not fraudulent, right? And 15% per month, or 75%, up to 75% of the total amount for the fraudulent cases, right? So, in other words, if taxpayers somehow fail to file and fail to pay, right, subject to both late filing penalty and late payment penalties, then they only need to pay for one, right, basically, right, for one type of penalties. So that is really generous of the IRS and of the government, right? So that's pretty much it for the chapters, and in the end, it's just another example of late filing payments, right? But since we are kind of out of time here, so I'm just going to skip that, and you can read that on your own. So that's the end of chapter 8. So by now we already covered all the materials that are going to be tested on exam number 2. So after this, I will try to make a video that provides some of the practice problems, so that you can better prepare for the test, just like last time, So if you have any questions on top of that, or about anything about the class, about the materials, about the exams, please let me know. And I also set up a let me show you. I also set up a forum on Blackboard. So if you have any question, you can post there as well, and I will try to answer as fast as I can. And if any of you know the answer for any question, please help out as well. Okay, so you can go to discussion board, and then you go to accounting 3043. Right? So this is the forum that I created for our class. So if you have any question, just post it there, or you can email me. All right, so that's it. That's the end of this lectures. So yeah, so I hope you guys are doing okay. Again, if you have any questions, just let me know. Otherwise, I'll see you in the next video. All right.